Hello and welcome to Trading the Trend. My name is James Boyd. I do not have my green shirt today. I'm using it as a little, what do they call that in Spain? Andale for the Bulls. We'll talk about here the trend, but I got a shirt as close as I could to green. I knew you would be expecting that. So a little fun there in chat. So just real quick, I'd like to welcome all of you here today. We got JP with us, Chris B, Austin, Silas, Greg, Hope Thomas, and Ron Hovis, and Dom, and many others. Welcome to all. Just real quick as we get started, remember I do post educational content also on X, so when I'm not teaching, I'm on, my handle is @JamesBoydCS. Check that out. Do post throughout the week as well. Real quick as we get started here. Now remember this topic, we talk about trading the trend. One of the things we've been talking about is be very careful who you listen to, okay? Because sometimes when you listen to other people that are talking about trading counter trend or everything's falling down, boy, have they really missed it in 2025, okay? So the thing we want to try to do is align the paper money examples to the trend that we're currently seeing, okay? I know sometimes it doesn't feel comfortable, but usually doing the right things usually go against the grain. So we want to kind of practice that with stock and option examples. Remember when we talk about options examples, options carry a high level of risk, not suitable for all investors. With options, we can have things like defined risk, trades. We'll talk about that here today. And also remember the information here is provided for general informational purposes only. Schwab does not use the Schwab does not recommend the use of technical analysis as a sole means of research. Yesterday we had a class on fundamentals. We talked about kind of what happened with the Fed, kind of what we'd like to see in terms of bullish investors, like what would be a win. We talked about that yesterday. And also remember that in our examples here today, and as we have done in the past, remember we will use the paper money software for application for our application, and we're going to practice different types of strategies. Now remember that investing involves risk, including loss of principal. Now today I want to take a quick look at kind of where the market is. I want to talk about some past trades. I want to talk about rolling. And as we do that, I want to kind of talk about maybe the good and the bad of options when you have expiration and or you have something where there's a max gain to it, and you're going to see that. So we're going to spend a little time talking about the markets first, then talk about current positions and managing / rolling those positions. First off, let's pull up just real quick. Let's go SPX first, okay? Now, yesterday we kind of talked about, if you didn't see that, I teach the class on trading growth and value Wednesday at 3 p.m. Eastern. That's a really nice kind of class to go back to and review because we kind of talked about the intraday price action after the Fed or during the Fed. Today we actually woke up, not a bad way to wake up, gaps to the upside on the S&P 500. And you're going to see that today, if we close here, we would see another close above the high of the low day. That range on the S&P yesterday was slightly over 1%, not huge volatility, okay? 1% from low to high, not much of a move percent-wise. If we go back and look at the weekly chart, these trusted whole moving averages, they have been Christmas tree green on the weekly chart. So when we talk about trading maybe days to weeks, we're talking about 2-3 days to 2-3 weeks. If we're talking about trading weeks to months, we would say 2 to 3 weeks to 2 to 3 months. And man, I'm telling you, since April 28th, I mean, they've been green for a long time. Now, we could have said all along the way, we're at the high, we're at the high, we're at the high. Again, what we know is if we're at a high, that actually means that is a confirmation of a what? That is correct, an uptrend. Now, when we actually go back to, let's say, the Russell kind of having a little unusual candle. This is the channel we've been talking about. Yesterday, we went up to the top. Some investors sold that as it faded back. Today, we actually went down to the middle of the channel again, or started there, and now we're pushing. Felt like saying pounding, but some of you are probably thinking that. Pounding that top of the resistance again, and it looks like it maybe wants to break the top of the channel. Now here's the deal. Does it always have to stay inside the channel? Absolutely not. Can you get diagonal breakouts that are like horizontal breakouts? You better believe it, okay? So can the Russell break out of this little consolidation range here? Maybe. Okay, smaller cap still on fire. Now the NASDAQ had a better day today, a little gap to the upside. And so far, this is what we mean by green candle, right? The green candle, where if we closed here, we're closing higher than where we opened. Good, okay? Now, if you actually take a look at, let's say, the Dow Jones itself, you pull up the Dow Jones, nothing to kind of report there. It didn't go up as much, but there's a number of, let's say, Dow stocks that do kind of look a little interesting. Like what? Okay? Now, if we pulled up, let's say, the market watch just real quick, go to the Dow Jones. I mean, one of them that like hits us in the face is NVIDIA, okay? Now, I'll kind of give you a little peek, okay? What the semiconductors, now I don't know if you've ever done this with your phone, laying in bed, you're trying to wake up, and your eyes kind of maybe crusted over a little bit, and you're like, am I seeing the semiconductors? You try to look with one eye so you can really take a good look. Semiconductors exploded out of the cannon here today. It almost was like the retro of what we used to say, and down the stretch it comes. I mean, look at Micron, look at Clack. I mean, there's so many. Look at AMAT, LRCX, okay? So we got to go back and kind of take a look at, really when you look at the Dow Jones, NVIDIA, that's going to be one that we kind of focus on a little bit here today. Can NVIDIA play catch up to some of the other stocks in the sector? Now, be very careful. I'm looking for the perfect search. I'm looking for this. Look, you're probably right in front of your face. This does not require a search. This requires you just clicking on a button to actually pull up the list, okay? Now, by the way, when you click on this right here, if you want to go down by sector, it will show you by sector, okay? So if I went down through this list and said, which financial stocks are strong? Which healthcare stocks are strong or not? Which industrial stocks? Meow, Caterpillar, okay? Don't forget CMI. And you're also going to notice that when you look at the information technology, the one that's the strongest is NVIDIA, but don't forget about IBM. Now, let's kind of have a little bit of fun here. Before we do, let's actually go take a look at the VIX. Now, remember, the VIX, kind of not unusual, right? You go into something like earnings or maybe a major data release like Fed or jobs report, something like that, and you actually see the volatility creep up. Now, it didn't explode, okay, but it did creep up. Good sign here today. We actually see the VIX fall back down, okay? Get down there, okay? Now, I want to talk about just real quick sectors for just a moment before we look at past trades, okay? And the reason why we look at the sectors is we want to know, think of sentiment, okay? Now, remember, when we talk about, let's say, sentiment, you know, we would think of all the way up to the right, like growth stocks, maybe like technology, discretionary stocks, and all the way to the left would be like utility stocks, staple stocks. Some people call those boring, okay? Whatever you want to call them, we would just kind of say they're kind of more monopoly-based businesses. They cash flow typically, they pay more dividends, and the ones to the right, let's say tech and discretionaries, they don't pay as much in dividends, okay? So they're trying to grow the business by not paying the dividends or trying to just grow in general. So when we look at this list on the left-hand side, there's the semiconductors, okay? SOX, we'll include that in sectors. We see actually technology, and it obviously, if you looked at, let's say, the NDX or you look at the SOX, not a real surprise there. And if you take a look at IXI, is that maybe starting to get a little push? Now, I don't think it's broken out of a range yet, but there are a couple stocks in there, as we'll show, that have gotten a pretty good push. When you look at the transports, has it gotten a breakout? No. If you actually take a look at the utilities, has it really got a breakout? No. Bounce, maybe, but still lagging. You look at real estate, fully sideways. This is like driving on I-80 through Nebraska. Now, no offense, I was born in Lincoln. So, but it's true. Now, if you take a look at this, the IXY, the discretionaries, now that's more of an upward trend, right? So we got really technology, we got discretionaries, financials, that was a brand new high here today. And you actually take a look at the healthcare, are we still getting that little push? Ran up, pulled back, but still holding the support. Not getting a fall through or higher low yet. And you look at actually communications, and what you're now going to notice is hit a brand new high. Now, not really surprising. The one area that we want to kind of keep an eye on is also energy to see if that could actually break to the upside. Notice right here when you look at gold and silver, if we put those on there, gold and silver okay? And we can put that, I'll just use gold as the proxy for precious metals. We do see red, red. Now, sometimes I get people ask me a question like, hey, can you talk about exits? Well, it's same thing. It's really 1, 2, 3, but red colors, okay? Exactly. Gold and actually silver are both showing kind of red right now, okay? And they already had a crossover. So really yesterday or today, both gold and silver showing a little consolidation after the rip that it had to the upside. And it was a rip. It wasn't just kind of a small, gentle move. We're talking about the price of gold going up 10%. Think if you're like a central bank and you're sitting on $2 trillion worth and you just went up $200 billion in the last 3 weeks. I mean, it's incredible, okay? This is not just your retail investor buying gold bars at Costco, possible, okay? But the fact of the matter is this is central banks pushing money around, okay? Now, the biggest actually thing is, let's kind of talk about some of the things in the paper money account for just real quick. So to highlight, of course, we're talking about semis, we're talking about tech, we're talking about discretionaries. We're also talking about financials. We're going to keep communications, include that. And we're also going to kind of keep an eye on the energy space. That is probably where we're going to find examples. Now, just quickly, we're going to talk about these paper money trades for just a moment. Now, one of the good and bad things is options, some of them, at least the ones we're talking about here, they have defined risk, okay? And what you're now going to notice is I want to piggyback on what I just said about gold. Now, this is an example of really AEM. Now, we're going to do this quickly, okay? When we look at AEM, this position right here, a 130, 100 short put vertical. Now, it's a wider short put vertical. And if we have a wider short put vertical, it's probably kind of more like a cash secured put with downside protection. Okay, now the problem with this trade is here we have 1 day remaining. The option was sold for $5.90 and there's 2.5 cents. Now, we would never say language like, oh, there's no way the stock can go down. What you better believe it, okay? And if you've been on the opposite side of those conversations, that's the saddest thing when the investor was like 99%, okay, max gain, and they left it and lost all the 90%, 99%, and more. Now, remember, when that short option that was sold to 130, if it's 5 cents or less, can buy it back commission less. What we're going to do in this case is I'm going to buy that back. That's the bullish side of the trade. That's where the gains are. We're going to create a closing order and we're going to buy that back. Now, wait, if we just buy it back, what are we doing? We're just closing the position. Why are we buying it back? Well, because you sold it initially. You sold the put to get a credit. Now we're buying it back for debit. If you're down, if it's -1, how do you get to 0? +1. And all we're doing is we're buying it back, confirm send. On this, it's going to show the commission, okay? And what we're going to go ahead and do is send that. Now, notice in this case, we did not roll the position, okay? Why are we not rolling the position? We're not rolling the position because the position or the stock is not showing an entry setup. What color is the 10-period moving average? Red. What color is the 20-period moving average? Red. What color is the hue or the shading on the moving averages? Red. So in this case, if the investor already has maybe a decent percent, they might say, I don't see a setup. The key word is yet. Now, that does not mean they might not get in a couple days, but at least right now, they're not seeing the setup yet. So I go back to this just real quick, and we want to make sure, can this fill? We're not going to forget about that, and we want to kind of just keep an eye on that. Now, the other one I want to kind of take a look at just real quick is Palantir. Now, notice this expires tomorrow. This expires tomorrow. Sold it for $5.70. Now, is this kind of the same thing? This is more your classic vertical, albeit that it's 15 points wide. And what you're now going to notice is sold it for $5.70, missed the opportunity to buy the shares of the stock. Now, let's go to, so on this AM, that was an example of we're just exiting and not rolling because we don't see a setup to get back in or roll. Now, if we look at Palantir, what I'm going to do on Palantir, that position is 99%, 307. I'm going to right click on that, create closing order, and then buy it back. Now, if you only buy back the short side, what is the risk? Well, you got a long put out there. What does that long put give you the right to do? It gives you the right to sell the shares at 140. So the only way that, well, two main ways that becomes worth something is the stock goes down close to 140 or below 140, and or the volatility explodes. Okay? So can that become worth something? Yeah, it can. Now, how much on the long put can we lose on the long put? Answer 260. How much were we down? We're down 258. So you got to realize on a short put vertical, that's the bullish side of the trade. That's the bearish side. It's the offset. And now what you're going to see is we're going to try to buy that back. We'll try to buy it back for a nickel, confirm send, note the commission, check it in real, what it would be. Okay, should be commissionless at 5 cents or less, send the order. Now what I want to do is if I went back to Palantir for just a moment, let me ask you a question. Would this be an example of exiting the position and saying, no, there's not an entry setup, or is this showing more of an entry setup? That's a question. Now, if I put these stocks two side by side, you'll notice, first off, the shading is green on this one, okay? Number two, the 20-period moving average is green. The 10-period moving average is green. That looks like a complete flip of what we just said. That's true. So can the investor try to profit take and then establish a new position? Yeah. Now they call it rolling. Now, first off, when we roll, we could just do it all at once, okay? For teaching purposes, I like to kind of get out manually like we just did and then reestablish another one, okay? Now, what I want to do here is I want to just do trade number one. I want to go back to this just real quick. We're going to go to the October expiration. So first off, when we look at this, what's the volume on this? 44 million on the shares, okay? So this tells us something immediately about the options. Is there a pretty good chance that there could probably be pretty liquid options? And we would say probably yes. Now, if we go down and look at the volatility, what you're now going to see is on the right-hand side that annualized volatility, which is a big no-no to annualize, but let's do it anyway. What you're now going to notice is that's pretty high, okay? 53%. So we got a percent and this dollar amount plus or minus $26 from now until expiration. Now, why do they annualize? It's a means for comparison, okay? That's why they annualize. But some aspects, they don't like to annualize. Here we go. Now, what we're going to do is we're going to come over to the put side again. Now, remember, if you did a short put vertical, you're trading more of the probability. You're trading the long call vertical, you're really trying to trade for more profitability, higher upside potential, okay, gain-wise. But if the investor said, James, I want to kind of do something about more probability, if you do higher probability, you get less profitability. And what we're going to do is we're going to sell the 170, and then what we're going to do is buy the 160. Now, when we pull these up for just a moment, so when I look at this, kind of what's the bid-ask spread on the at-the-money call? 5 cents. What's the at-the-money spread on the 175? 10 cents. Okay. Probably would have known there would have been a decent chance to get a tight bid-ask spread. And I'm going to tell you right now, when I've ran into investors, non-Schwab clients, and they start talking about investing wherever I am, it's always amazing to me when I look at kind of the stock examples they show me, how little volume they actually have. Be very careful on tickers that just have low volume. When I say low volume, I'm saying anything less than 250,000. Many investors would prefer 1 million as the low point. If you're going lower than 1 million shares on average, you better hope that that actually kind of gets more over time. That's not that much, and it probably actually tells the investor you might not be able to do options on it. Now, why does the investor want options on it? Well, kind of think of it like this. You buy a house, but they say you can't protect it. So how much is the house worth? You buy a car and they say it's in such bad condition or it's so low liquidity, we can't even protect it. So how much is the car worth? So many investors, if they're going to buy an asset and outlay a capital, they want to know that, can you protect it? Can you try to make income from that position? So to do that, the investor actually needs shares on the position. So that way the options have a greater chance of having options, okay? So there you go. Let's say the 170, 165. Let's confirm this. We can't assume. We got a 10 cent bid-ask spread there. Volume is 1,100, 5,300. Decent. You go down and we'll look at the 160, 10 cents there, 24.50 on those. Volume is today. Open interest is cumulative. And what you're now going to notice is 8,500. So we look at the 170, 160, and let's show the example of what the max loss is given the vertical, okay? Now, if we take a look at this, we now see the max profit, the max loss, given one contract. Note the commission as well, okay? Now, what I'm going to do is, so we get a credit, but that credit is less the commission, and there's the net credit, okay? Net credit just subtracting the credit off, subtracting the commission off the credit. Now, we're going to go ahead and send the order. So trade number one, profit took on actually Palantir, okay, and then reestablish the position. The previous thing we actually did before that is AM. We try to take the gains, but that position has not filled yet. Now, what I'm going to do is I'm going to try to overshoot this maybe by a nickel. Now, here's kind of the problem that you can actually have. If you wait until the day before expiration, they might not be as liquid to get out. So if we go look at just real quick on the AM position, what is the position? Is the 130. You're going to notice that that 130 is way out of the money. And when you're way out of the money, what happens? Well, you're going to tend to actually have low volume. So when you're saying, I put my order in, something's wrong with the platform, no, something's not wrong with the platform. It's called, this is why we talk about exiting 4 to 10 days expiration, so we don't run into a situation where there's not many investors trading those. They've already moved the positions or have planned to go to the expiration. Okay? Now, what I'm going to try to do just to get out of the position is I'm going to try to overshoot this by nickel to see if we just can't get out. Okay? Now, what's happening is I'm overshooting the ask price by a nickel. Chances are pretty high. We could probably get filled. It canceled that order. We're just wanting to make sure that we can get out of that position. And Luke makes the comment. There's no one to sell to. Yeah. Other investors have already planned their trades going forward. They did not wait until the last second to finally get out. So this is the danger going inside less than 4 days. 3, 2, 1, the day of expiration, when the liquidity has dried up. Now, what I want to do is I want to see if there's any questions just real quick. Jacob actually says, is there a ratio to compare volume to underlying price? No. Okay, so we're using a flat bar. Okay, so it doesn't matter if we pulled up Wells Fargo. It doesn't matter if we pulled up Google. It doesn't matter if we pulled up NVIDIA. Million shares on average or higher, flat bar. So we're not talking about any percentages or anything like that. If we get to 1 million, if I pulled up Wells Fargo and then actually look down at the options, if that's 1 million, there's a greater chance, that does not mean absolute or 100%, that those bid-ask spreads are probably going to be tighter. The goal of the options is to get them where the bid-ask spread is tighter than 20 cents. Now, in real life, it's harder to have that less than 20 cents if we're trading bigger dollar stocks, okay? When we say bigger dollar stocks, we'd probably say anything greater than $300, okay? Now, let's kind of show a couple stocks. So, Jacob, there's your answer there. Now, just real quick, how can I load the scripts for the columns? So just briefly, let's go back to this just real quick. Now, so this is on my X page, okay? And what you're now going to notice is I just sent the link to my X page. Now, what you're now going to notice is the scripts that we use, okay, we just put them right on our X page, X formerly known as Twitter, okay? Now, when I click on this, now what you're going to see is on the left-hand side, think of this like a menu at a restaurant, okay? On the left-hand side, week percent. That's a script for the week percent. The blue, think of it as the price or the code for the script. Now, you can't copy and paste that, so to say, because it's not a Word document. However, there are some of you smart buggers out there that tell me, hey, James, you know, I used Snagit or one of these kind of like type of capture devices, and I did that. And so what happens now is what this does is it really can capture that, it captures it and you can copy and paste it that way. So that's one way you can do it, and I've tested that and that works fine. So now remember, those are case sensitive, okay? Now when you load those, all you're doing just briefly is going to go up to the top right, setup, open shared item. So you pick a script that you would like, and then you could just really copy and paste that in, okay? Now, when you copy and paste that in and go, it will say preview and then import, you want to then really go to the page of Market Watch and then quotes. So these column headings now, you can right click and customize. And what are you customizing? You're customizing the columns, okay? So that's what you're doing there. Yeah, but you can copy and paste that, okay? And if I did that, let me just see if I can't grab that myself. I've done it before. I just want to see. Yeah, you can do that, and I've done that before. I mean, the example given, I'm using Snagit. That's not the only one. There's other ones that do it, but there you go. Okay. Now, just real quick, I want to go back to, let's go back to semiconductors for just a second. Okay. Now, I want to take a look at a couple semis, and I want us to compare the returns, let's say, to NVIDIA. Okay. Now, these are some of the gainers. We said, what, about a week or two ago, that it was Micron leading to the upside. It wasn't NVIDIA. And my goodness gracious. I mean, it's been today. I mean, we that's at a high, 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 that's at a high. It's too high. Okay. Now, I kind of joke about this, but you know, think about your marriage, right? Your marriage every day could be at brand new highs. You don't look at your spouse and say, look, we might as well break this trend right now because we're at the all-time highs, right? Probably doesn't make a whole lot of sense. Now, I want to kind of take a look at a couple of these. CLAC was actually a big one today, big pop there. Moving averages kind of just been Christmas tree green. You're going to also see that AMAT, for example, another big pop, another one. And you look at LRCX. Now, you got to ask the question now, my goodness gracious, okay? When we pull up NVIDIA does not have that same blink to the upside. Now, this is maybe where the investor says, James, I like to play the lagger. Now, there's a question that's going to happen here. How do you know if it's lagging? Does it look like the other charts? It doesn't, okay? I mean, this chart hasn't even broken above diagonal resistance, and the other ones have exploded to the upside, okay? I mean, just look at it, okay? Just look at those charts. We compared it to a Micron, CLAC, AMAT, LRCX, and NVIDIA. Not even close. We can look at statistical returns over the last week to 1 month. It's not even close. Now, let's say the investor said, James, I want to kind of play maybe a weaker stock in the industry group, thinking that maybe NVIDIA could be drug up by the space. Now, what's the danger in that? You're kind of hoping that the weakest one, so to say, recently, is going to perform more in line with the sector / industry group. Now, that word we just said was speculation, okay? You're thinking that it might snap back and go more with the industry group. Now, that's risky, but so it's risky trading something that has an upward trend. It's risky to do this. It's risky to do the other one. It's risk every day. Surprise! Not really. We know that. Risk is all over the place. Now, what I'm going to do is we're going to go down to the NVIDIA, and let's go back and take a quick peek at the volume on the shares. Now, this has 120 million shares traded today so far. That's not even the average. That's so far. Now, if we look at, let's say, the volume on the stock, 120 million, we look at the implied volatility on the right-hand side. That's still pretty high implied volatility. Why does the investor care? They're thinking might they buy something or sell something based on that number. Now, some people like to look at that where it is now in relationship to the 52-week range, okay? Or some people like to just kind of look at that number in general. Now, what we're going to do is we're going to pull up the October expiration. And what we're going to show here is we're going to show where if the investor says, look, I think potentially that the NVIDIA could stay up above a certain price level. Well, let's say they said, I think it could stay above 170. If the investor actually thinks that, they might do maybe a put vertical. Well, that 170 put vertical, you got a $4 bid. I'm right here. And you got a 405 ask. Now, again, we talked about less than 20 cents. It's a nickel. What's the volume like? 9,000, 79,000. You look at the 165, 2 pennies wide, 4,100 on 47,000. Now, what we're going to do is going to come back to this. We're going to right click, we're going to go sell, and then go vertical. Now, if the investor did this trade, they're really saying, James, I think potentially that it might go more up in line with the group. I'm not sure if we've ever seen a divergence like we've actually seen between NVIDIA and the space in general, okay? Now, I'm going to show also the 170, 160. If we did the 170, 160, it's 225 credit. If we actually did, let's say, the 170 in the paper money account and did the 165, it's $1.34 credit. For our example, so we don't have to do 2 contracts of the 170, 165, we're just going to widen out 170, 160 for a 225 credit. Thank you, Brent, for answering that question. Now, what you're now going to notice is I'm going to go to confirm and send. So trade number 2, now remember, if you roll a position, is that a new position? You better believe it. Second, if we actually enter this position, this is not a new position. So trade number 2 is NVIDIA, the 170, 160 put spread, okay? Now, let's kind of go back to something just real quick. So if we go back to, let's say, on the schwab.com, okay, don't even have to log in. Go to where it says learn. Not bad. Don't even have to log in. Do not log in yet. Go to learn. Go to Schwab Coaching. Now, the reason why I want to kind of point this out, if a lot of you kind of say, James, I'm a probability-based person. I like math, things like that. Join the group, by the way. Click on Schwab Coaching. What you're now going to see is, I want to kind of show you something Brent teaches class on Friday that I think will be extremely helpful. If we go to where it says overview, live webcasts, and virtual workshops, you're now going to see the upcoming webcast. Now, just real quick, learn, haven't even logged in yet. It's right there. Then Schwab Coaching. Now, click on this. If we go down a little bit, you're going to see that this straight up calendar here, we go down to what date are we here? Here we are on the 18th. Now, Brent teaches this class right here, okay? Advanced Option Strategies. Advanced Option Strategies are really looking at kind of these verticals, maybe diagonals, synthetics, okay? Iron or Iran condors, all the above. Any trade that has like a max gain, max loss that is kind of more about probability and also what we would call time decay. Now, some people like to use that to try to complement their portfolio where everything is not trading a direction. Sometimes the direction might be more neutral, okay? So check that class out for sure. Now, just real quick, I want to go back, and if we say send this order, there's the max profit, max loss given the one contract, there's the commission. I'm going to go ahead and send that order, and it fills, okay? Now, I want to go back to something just real quick, and I want to pull this up for just a moment, okay? Now, for time's sake, when we take a look at, let's say, the position, one of the other positions that's kind of, it's at that point I just want to kind of show you, we've ran out of time on United Airlines. Cash secured put for 325, it's at 11 cents. Now, what you're now going to notice is if we wanted to, we could say, hey, what trend is United Airlines right now? And it's really in trend 4. Trend 4 is the stock above both moving averages, but it's an area of resistance. Now, if we look at the whole moving averages, 10 whole, 20 whole, what color are the moving averages? It's been down for 4 days, or red for 4 days, and it's been red for 4 days. So if we said, are we probably going to roll that position? Well, remember, if you get red moving averages, we already said that that's not an entry per the rule set that we talk about, okay? So this is more an example of getting out of the position. Let me show you the chart so it sinks in what that actually could look like. So if we look at the chart, it says it's been red, the moving average has been red for 4 days. 1, 2, 3, 4, okay? 4 days in a row where the moving average has been red and we're not breaking above resistance. Now remember, the trend said we're at trend 4. It's up near resistance. Go back to the chart. Is it up near resistance? La la. Okay, still right there. Now that does not mean it can't break out. You might set the alert. But the moral of the story is we are out of time on this position. We're going to right click on that 92.5. We're going to try to buy it back. Now again, what's the problem with waiting to the last second? The problem is it's the last second. And just because I have planned poorly potentially doesn't mean other people do. Create a closing order. If they know there's poor liquidity and it's hard to get a fill, they probably would not repeat that or try not to, meaning they're probably going to try to get out prior, hence 4 to 10 days. We're going to try to buy that back. We're going to say we're going to try to buy it back at the mid price, slightly higher, confirm send the order. Note the commission there, send it. Now this is kind of good and bad a little bit. The bad thing about options is maybe they expire to a degree. The other bad side about this is if you wait till the very last second, they might be less liquid. And the other bad thing potentially is about them is if this stock would have gone up to, let's say 200, it's capped, okay? So sometimes if it goes in your direction, you sure wish maybe you complement the portfolio. I was getting choked up about maxing out. But the biggest actually thing is there's a bad part is this is why some people like to use stocks and options. But the stock, there is no expiration, okay? The bid-ask spread, you don't tend to have those issues because there's not an expiration. You can have a wide bid-ask spread if there's a volatility event, okay? But there's also the biggest thing about stock versus option, there's no max gain. The stock can go up to infinity, and the biggest thing is the stock has a constant delta, okay? So in other words, if we had 100 shares, the stock goes up $10, we still have 100 shares. 100 shares, 100 delta, okay? Now, that's another one we're going to try to get out of. Now, what I want to do is I'm going to kind of fast fire through a couple Dow stocks, okay? So when we look at, let's say, Caterpillar, okay? Now, Caterpillar was your classic example of breaking through horizontal resistance. Now, remember, someone doesn't need a special search to find stocks hitting brand new highs. You can go back to the tried and true 20-day high, which is really a 1-month high, and you could actually see which stocks are really hitting a brand new high. Remember, this 20-day H is really representing 1 month of trading. The 55 is really that 2.5 months. Think of the 20-day as shorter term, and that 55-day really being kind of more intermediate. I'll come back to that in just a second. Now, when we look at, let's say, Caterpillar, is it too far gone? Well, it smashed through the 161 and it hit the 200. Could that be a flag potential setup? It could be, right? Now, another stock in that same space that's also gotten a pretty big push here today, just going to flash a couple stocks, is CMI, Cummins, okay? Brand new setup here today, maybe not as deep into that trend keyword as yet. We talked about some of the cards yesterday, American Express, a little continuation of that. And I want to go back to one of them. Now let's go look at Amazon for just a sec. Keep an eye on Amazon. It kind of ran up, snapped back, trying to create a new base. Not a setup, at least today, per what we talk about. But the one I want to kind of bring up is really IBM. Now, when you look at this chart, if you zoom in on this, I just want to kind of pay attention to where do you see resistance. Now, kind of an odd looking chart. And if we went back to this chart and say, well, there was a gap down here. There was a gap down all the way to here. Okay, now there's like, some people call this a big hole in the chart, or there's a channel there, okay? Now, if you take a look at this along the way, okay? Now remember, let's kind of connect the dots, okay? Here we actually down here, down here, down here, down there, down here, and down here. And what you're now going to notice is those dots are getting higher, hence higher lows. Now, what you're now going to kind of see is this is the first level of resistance, and this is the secondary area. Now, these trades are kind of interesting because if someone was bearish, they might say, look, if it breaks resistance, I'm going to get out of my bearish stock trade, example given. So they buy it to get out of a short stock position. Second, bulls who are trying to just get in general, they say, look, I'm going to buy the shares. Or they actually say, I have shares, and the brand new breakout, I might dollar cost average. I might buy more. So really, you kind of have three things that are happening, okay? Now, in this trade example, let's say the investor says, look, I want to try to buy, let's show this example of kind of going to something that has a higher potential upside gain. Now, when we choose something, let's say a long call vertical, we're buying a call. When you buy the call, one strike in the money or two strike in the money, you're trying to actually have some leverage, meaning you're not paying as much for the call, okay? And if it goes up, it has a higher percentage gain or loss given actually the capital invested. Now, if we look at this right here, 30 cents wide, you look at that one right there, 25 cents wide. Now, the big thing I would need you to understand in this example, if I said if it's more than $300, the spread might be a little wider. Now, it's not 300, but we're close. And you're going to see that spread, it moves on us, given the liquidity in the market. It's 15 cents now. Shut my blinds. Maybe someone saw us talking about it. It's 10 cents now. So disregard everything I just said. That's what it seems. Now, we're going to right click on this 260. And then what we're going to do is, let's say, buy and then vertical. So we got to understand that the liquidity, the bid-ask spread can change given the orders, etc. Now, what we're going to do is we're going to do the 260, the first in the money strike, and then sell really the 270. Now, what you're now going to see on this is the 260, 270, there's the debit. Now, the long call vertical, you have a right to buy the shares at 260. The right is not free. The investor pays 485. 260 plus 485, 264.85 is the break even. Now, what you're now going to see is the max profit. You get a spread of $10 less the debit. Max profit is $5.15. And what I need to do is put that right so it goes in that paid money count. We're right there, okay? And this is what we were looking at. And now if we do that, it's going to show us, now we said $5.15. That price moved on us a little bit, but we'll use this. I want to kind of see, is that the same number? That's 485, okay? 485. For some reason, I thought it was a little higher. So here's the numbers we were looking at. We're going to put it in the paid money count, the IRA, break even, max profit given the vertical, and the max loss, okay? Now, on IBM, a goal of the investor might be, hey, I'm trying to get a certain percentage of that max gain. Or they might say, James, I was kind of thinking more about if it went up to maybe halfway in the channel. Wherever we are at that point as far as potential gains, I'm going to try to grab that. Maybe the target of 272, 281. You just need to kind of understand something. When you look at this trade, what is the delta of the position? Simple. Delta of the position, 59. You're selling actually the 70, the 270. It has, if you don't mind, I'm going to say a delta of 20. What does that even mean? Well, if the stock goes up $1, okay, so if that stock goes up $1, okay, so if we went from here, 263, up to, let's say, 272, it's about an $8 move on the stock. We get an $8 move on the stock. We translate that $8 stock move, and we're going to translate that by the delta. What's 8 times 20? It's 160, okay? $160 of that max gain. Now, if we go up, let's say, the higher potential target, if we went up, let's say, from here to here, that's actually, let's just say a $20 move, so we can kind of don't have to play odd numbers. If we had a $20 move, okay, $20 stock move, what you're now going to notice is $20 stock move times a 20 delta, translation, about a $400 gain of the max gain. That's all it is, okay? So the stock move is the stock move. The delta is just telling us if the stock goes up $1, how much does the option gain or lose by, okay? I'm out of my time here today. I want you to go out. There's a ton of stocks to practice breakouts in. You're seeing many of them. We did 3 brand new trades here today. Stay tuned for our next webcast coming up right at the top of the hour. That next webcast is Short Verticals by Barbara Armstrong, okay? And I want to thank you so much for your comments and your participation. And also remember that we have 2 classes after that one as well, so feel free to join us. Now remember, with what we discussed here today, it was done for example, illustrative purposes only. Subscribe to the Trader Talk channel, that way you can see our content. I'll be back on tomorrow morning with Trader Talks in today's markets, talking about ETFs. That is a non-recorded class, so join us live. And also remember Brent's class tomorrow as well. So with that said, thank you so much for attending today's class on Trading the Trend. Have a great day. Take care. Bye-bye.